Today, we're going to talk about financing your small business. How do you go through this? What should you be thinking about? And how to get financed? Coming up next. So financing your endeavor can be a really long and arduous process. There's so many different ways that you can skin this cat and get the financing that you need, either to start your business or to grow it. With all of these different avenues to go down, which one do you pick? Which one is best? And more specifically, which one is best for your business at this specific time? Right now, we're going to dive into a couple of these and unpack them so you can understand what the best financing is for you. So the first kind of financing, this is kind of a catch-all. We generally refer to this as traditional financing. And traditional financing is kind of the foundation of the financial options that you have. Now, some of these seem really obvious, right? You've got the money and you finance it yourself. Maybe you finance it with your credit cards. Other ways of traditional financing for starting a company or growing a business, that could be taking out a second loan on a house, that could be a HELOC or a line of credit. Some of the other traditional types of financing is going to be more along the lines of using a traditional bank and actually going through that process. Now, another opportunity is the Small Business Association, or SBA loans. A first step for those is you actually have to try to get qualified through a traditional bank or maybe even a credit union first. You have to try that first and actually have to get declined before you can move into this SBA role. Now, both of these are pretty long processes, and a lot of it is going to be built upon your business plan. It's going to be built on how much money are you actually investing or putting into this business. A lot of it could be based on your personal credit score, credit history, how valuable the bank believes that you are in their particular mix of loans that they want to serve and they want to make. So you start with that, and always start with this process. It can take an incredible amount of time. You know, some of these bank applications that I've seen can take up to 16 hours to fill out because there's just so much information that they require. But this is your starting point, going through that initial base financial application of working with a bank or a credit union and trying to get funded through there. Now, this is probably going to be your cheapest option from interest rates and what you'll be paying in fees. Generally, it's also going to give you the longest period of time to pay the loan back, which as a small business is a really incredible benefit that you want to have. The longer you have the time to pay it off and the less you're paying in interest, the more money that you can keep in your business at a time when it's necessary. Now, from a traditional financing standpoint, keep in mind that generally speaking, only about 20% of business owners can actually qualify for this traditional bank financing. So even though it's a starting point and it's generally where everybody wants to start because you may be able to move into the SBA process, keep this in the back of your head. It may not work for you at this time, and that's okay. Like I said, only on average about 20% of businesses are able to qualify this first time that they go through it. If you're one of the 20%, awesome. You really don't have to watch the rest of the video. You've been able to go through this, you got your financing, move on, check out some of our marketing videos and start learning how to grow your business. That's the value for you. For everybody else, keep watching and we'll talk about a couple of other options that are available to you. Now, another type of financing that's incredibly popular and really valuable is this business line of credit. It's a revolving line of credit that you can have access to. Now, the application process for this is very similar to what you would consider for a traditional bank loan or maybe that SBA. There is a heavy look on your personal finances. Sometimes there's a personal guarantee. They're going to look at your credit score, look at the health of the business. Has the business started, or are you getting started? What's your business plan look like? Things like that. The value in this is that sometimes you can use this just to finance the business from A to B, or you can use this to augment other things. So maybe you were able to get traditional financing, or you're able to finance the start of the business yourself, but you need some additional capital in order to purchase inventory or pay for marketing. Maybe you're needing to ramp up for the holiday seasons, right? So a revolving line of credit is incredibly powerful because it essentially gives you a bucket of funds that you can pull from, use as you need within your business or within your corporation, and then pay back. Very similar to a credit card, although the costs are generally going to be a lot less. You pay less in interest, and it might even give you a longer period of time to pay off. Now, just like any type of financing, you want to make sure that you're making the right choice for your business at that time. Maybe you're a seasonal retail store, right? So you need to pre-purchase inventory for your holiday season. or the big season. Maybe it's back to school, maybe it's Halloween, maybe it's Christmas, something like that. So you pull these funds as you need, you pay for your inventory, or you bump up your marketing, you have some more content written for your website, something like that. And then you've got some time where you're paying your minimum payments back until now you're through your holiday, you've made your money, you know, it's Christmas for your business, and now you can pay all of that off. Everything that you pay off, unlike a traditional loan, becomes available to you again. So this is something that you can use during the slow seasons when you need to pay staff, pay rent, you know, restock on your inventory, things like that. You can use this again and again and again. As you pay these off, that particular financial industry or financial institution may bump up your credit, may give you more access so that you're able to spend a little bit more, buy some more inventory to last you through those seasons where you're really going to make your money. So it's a really powerful tool. You might be able to use this as a part of your starting costs. You may also be able to use this line of credit in order to get the inventory and the things that you need to grow your business. So very flexible, great opportunity, and definitely something to consider. Another opportunity available to you is a business credit card. Now this varies from using your personal cards because this is going to be dedicated and specific to your business. Now, still, just like traditional credit cards, this is going to be based off of your financial situation. So you may only be able to get a small line of credit or a small approval first, and that's okay because you want to get started with this so you can start to build your business credit. Business credit is going to be a little separate from your personal credit, but they both still interact when you're talking about getting financed. So you want to make sure that your personal credit has been taken care of first, then apply for different business credit cards, or find one that you think, I can get started with this one, this achieves what I want, and then get approved for that. You may take a time or two, you may have to apply for a couple different ones, so keep in mind every time you apply, it dings your personal credit. Obviously it takes time out of your day from running your business. But by building this and getting the business credit card, you start to build your own credit profile, which will help when you need to go back to a bank or you need to go back to some sort of financial institution to get more funding. So it's always a good idea to try to get a business credit card, especially if it has any type of rewards. A lot of them will give you cash back or a percentage back on what you spend. Some of these credit cards will give you no interest for 12 months, 18 months, something like that. That's a great starting point. Because again, you can finance what you need for your business, for your growth, or for starting, and then pay that off over time. Now, of course, you want to make sure that anything that you are borrowing is something that you feel the business can support paying back. What you don't want to do is find yourself in a situation where every single time that that you're paying something back, or the loan or the debt becomes due, that you're taking these funds out of your personal money and your personal bank account. Keep your finances as separate as you possibly can, because that helps you grow your business credit profile and get qualified for different financial tools that will help you grow your business. Now, something else you may consider is a merchant cash advance. This is one of those that if you search online and you're looking into different scenarios, there's a lot of polarizing opinions about this. Some people are very into the idea. Other people say absolutely stay away from it as much as possible. It's a big risk, something like that. The way to get this, and there's value for different businesses depending on how you're using it. The way you get this is you have to be processing credit cards. If you're not processing credit cards, there's no opportunity for you to qualify for something like this. The longer you've been processing cards, the more history you can show, the better rates you get, and the longer term of time you have to pay that off. Now, the way this works is you're processing your normal credit cards. Maybe you've got a retail location or you're a food truck or something like that. You process your normal credit cards just like you would every day, right? A merchant cash advance is usually available through your processor, or it can be through us here at Marketing 360, marketing360.com/payments if you're processing with us. We'll take a look, and the organizations that we work with will take a look at how much you're processing and what your history looks like. From there, and looking at different aspects of your business and looking at different aspects of your financial profile, they can identify how much they can loan to you and what the costs will be to pay that back. Now, the value here is that you get immediate access to funds that you need. Like I said, maybe you need more inventory, maybe you need to upgrade your location, you need to upgrade some equipment, you need the funds to do it. This is a great way to get those funds based off of what you're already processing. So maybe they'll say, okay, we'll give you access to $10,000 and you generally process about $10,000 a month. Okay, we'll give you a year to pay it off. We'll give you 2 years to pay it off, something like that. As your credit card processor processes these funds, they will take a percentage out of what will hit your bank account. So you don't have to write another check. You don't have to worry about making sure that you're paying on time, because every single day when your batch processes at night, those funds will be taken out. 5%, 10%, 15%, whatever you've agreed on. This can be really, really powerful because you get the funds that you need and it's just automatically being paid back. The dark side, or the downside of this, is maybe you need every penny that you're processing at this time. So you can't afford to give 10% of your daily take back to paying off this, this merchant cash advance. So depending on your business and depending on your scenario, this can be really, really powerful. Or it can be a little bit dangerous because it reduces your cash flow on a daily and a monthly basis. So you've got to identify, does this work for my business? Is this something valuable to me? And can I pay back on a daily basis the funds to pay those back? Now the value to this is, as you pay things back, the merchant cash advance company may give you an opportunity to access more funds. So you got $10,000, you've paid back $7,000, and they say, okay, no worries, don't worry, that last $3,000, you're gonna keep paying that back. Now we're gonna give you access to another $5,000. You can start with that. Again, incredibly powerful. If you're about to hit your busy season and you know you're gonna be processing a ton, this will pay off really quickly. You need the money now to buy the inventory, pay it off during your heyday and when you're making all your money. Just balance this with the understanding that it is going to reduce your daily and your monthly take. So for your business, in your situation, it may work. Just consider, is this something that I need right now, or is this something I can wait on? Now, there are dozens of other financial tools that you can use. Different types of loans, different types of different financing options. We can't go into all of them in this video. You're talking about invoice factoring, you're talking about being equipment loans, maybe real estate loans, all of these different things. But these are really kind of the 4 that most people will fall into. The traditional financing of maybe friends and family, yourself, or traditional bank. You've got kind of the recurring line of credit, or those short-term loans that you get the funding now, you pay that back. We've got business credit cards, and then of course the merchant cash advance. These 4 are generally what people will lean towards. So take a look at them, identify which one of these or what mix of these is going to work best for your business. Understand that running the financials for your company is very different than keeping track of your budget and your financials personally. And a pro tip that we can give you here is keep them as separate as possible. Another pro tip I want to leave you with is make sure that you're using some sort of accounting software, whether it's QuickBooks or Xero or who knows what it is, because there's a myriad of them out there. By using those, that will oftentimes help when you're trying to apply for loans, because this is something that the bank or the financial institution can look at and say, yep, you're managing your finances effectively. Here's the last year, here's the last 6 months, 3 months worth of business financials. They can access that and look at it in a way that makes sense to them, whether it's a loan officer or it's an automated kind of algorithm that's looking at these. So that's the pro tip to take away from this, is make sure you're using an accounting software and keep your business and your personal finances separate. That will help you qualify, and that's going to help you grow your business. Thank you so much for watching. If you've got other questions, you want to dive a little bit deeper into any of these, please just let us know. You can also check out our website, marketing360.com/payments. We've got a bunch of opportunities for you there and a bunch of different tools that we can provide you with to help you get financed and to work you through these different tools and help you identify what's going to work best for you. If you like this video, please be sure to like, share, comment, and subscribe, because we're constantly posting new videos about new topics. Thank you so much for watching, and happy marketing.